This is section 4 of module 1, where we will begin with a conversation on integrated logistics, operational benefits. How can we as an importer use the concepts and tactics behind integrated logistics to our operational and ultimately financial benefit? The first bullet offers a hard and fast axiom that we can all embrace as we continue our studies. The reality of logistics is that every time your merchandise, information, and/or documentation changes hands, the probability of something going wrong increases and costs escalate. That's just the truth. It's a maxim. It's an axiomatic expression. Based on that axiom of logistics, how do we use an integrated approach to remove players that aren't adding value, drive down lead times, reduce handoffs, and by definition, also reduce costs? That's really one of the key missions of integrated logistics. There is an operational benefit to integrating the logistics function. The philosophy behind integrated logistics focuses on, we just said this a moment ago, minimizing handoffs between players, turning documents over 8 different times when you really don't need to, different players physically handling cargo when there's no benefit to doing so. That's what we mean by handoffs. Reductions in dwell time, goods, information, documents sitting around with no purpose, and the end-to-end control of goods movement, from the moment a need is recognized until that need is fulfilled. Some other operational benefits: when supported by the right technology, integrated logistics programs enhance supply chain visibility. We're talking about cloud-based solutions that allow importers and other permission-based players to go into a software as a service software module and determine the whereabouts of goods, determine the actual quantities of goods that are being shipped, look at scanned copies of documents like commercial invoices and packing lists. Technology, albeit digital, drives the quality of work out in the physical world. One thing we want to focus on, we'll talk more about in just a moment, is visibility at a container level for ocean freight, but also the purchase orders that are in a container, the goods that were originally found on a purchase order placed on a vendor by a U.S. importer, and then the item level goods that are part of that purchase order. Container, purchase order, item level. True granularity, true visibility. By definition, integrated logistics programs create opportunities to reduce costs. Importers have to avail themselves of those opportunities. Example, the bundling of international transportation services. Well, what does that mean? Using the same freight forwarder for air freight as ocean freight and negotiating better rates based on those volumes. Using the same freight forwarder as you do customs broker. There's a bunch of examples, but bringing parties together and bundling services is an important way to reduce costs and enhance control, for that matter. Reduction in service fees. We said a moment ago that every time goods, documents, and information changes hands, the cost goes up. To the extent that it makes sense to the U.S. importer, integrate functions with a limited number of parties, a limited number of supply chain players to drive down those service fees, and specifically eliminate transfer fees. That's a little bit obscure, but to get right to the heart of the matter, if we're a U.S. importer and we use a different customs broker in the United States than we do a freight forwarder at origin, when the freight forwarder at origin does their thing and moves the goods, and they arrive in the United States and they're either electronically or physically transferring documents to the customs broker, they're going to charge a fee for that. There are other examples of transfer fees, but that's the big one. A company can choose to do that for a lot of valid reasons, to separate the forwarder from the broker. We're not here to tell people what to do. We're here to point out some of the pros and cons of how integrated logistics works. Speaking of which, let's move on to some of those cons, the potential pitfalls of integrated logistics. Because while valuable, integrated logistics isn't all about rainbows and unicorns. There are pitfalls that companies, that importers need to be aware of and create a balance between the value of integrated logistics and going maybe a little bit too far, because that can indeed happen. The first one, legitimate concern, too much dependence on a single 3PL, a third-party logistics company. Putting all of your eggs in one basket with one freight forwarder, to get right down to the heart of the matter. or doing all of your trucking in the United States with a single trucking company. Just too much dependence. We want to put ourselves in the position as an importer to negotiate the best rates possible on volume, but we don't want to get into a situation where we're too dependent on a single entity. Sometimes, especially in an international environment, it's difficult to decouple 3PL services. That's kind of a fancy term. But let's go back to this conversation about integrating freight forwarding with customs brokerage. Sometimes once you do that, integrate the two activities with one company, it becomes difficult to break that apart, especially if we as the importer are utilizing the freight forwarder, the 3PL, utilizing their cloud-based services to gain the visibility we spoke of just a few moments ago. The deeper we get in, the harder it is to decouple. The other, for this slide, the forwarder's ability to engage in detailed PO management. Lots and lots and lots of freight forwarders offer PO management services. First of all, what does that even mean? That we as the importer make our purchase order information that we place on overseas vendors available to the forwarder so they can help coordinate those purchase orders at origin as goods are manufactured by our overseas vendors and tendered to the freight forwarder. In addition to the physical world services, the physical world coordination that forwarders engage in with overseas suppliers, the visibility they can provide is quite helpful. The only problem is not all forwarders can do that. So as we evaluate forwarders in this particular context, their ability to provide PO management support services, we need to pay lots of attention to what their true capabilities are. Some other pitfalls: not all forwarders perform multiple services equally well. Maybe they're better at ocean freight than they are at air freight. Maybe they started out as freight forwarders and bought their way into the customs brokerage business and it never quite worked right. Regardless of what the forwarding community says, no one forwarder can be all things to all men. We have to be selective about the services that we choose. Second bullet, another pitfall is the challenge of managing ocean carrier contracts versus negotiated rate arrangements with non-vessel operating common carriers, or what are known as NVOCCs. Well, that bullet point is a mouthful, especially if you haven't had exposure to import activities. Sometimes importers can negotiate ocean contracts directly with the steamship lines, especially if that importer has a lot of volume, a lot of containers to negotiate with. Other times, and we'll talk lots about this in the future, it makes more sense for an importer to work with a freight forwarder who is licensed by the Federal Maritime Commission as an NVOCC. The freight forwarder serves as a middle person who negotiates their own contracts with the steamship lines. And based on the huge volumes that those forwarders have, they can turn around and resell space on the ships to importers. That's a whole other subject, ocean carrier versus NVOCC. For now, let's just say, depending on the ocean volume that an importer has, it can be challenging to have contracts with a carrier and work with an NVO. More on that later. Third, technical challenges between beneficial cargo owners and the 3PL. If you've not heard the term BCO, beneficial cargo owner, just another fancy word for purposes of our conversation for the importer. The BCO and the importer, for the most part, the same company. It is oftentimes difficult for importers, for BCOs, to make the technological connections they need with the 3PLs. Sometimes the importer is limited or constrained in their own technological capabilities. Sometimes it's the forwarder. Sometimes it's both parties. We need to pay attention to that as an importer to avoid that type of pitfall. Tricks of the trade as it relates to integrated logistics. Some suggestions that importers can use, and we make dozens, if not hundreds of them throughout our modules. Let's jump into some real ones here. First, manage all imports down to a PO and item level. What are we importing as an item, specific product? In what quantity? On what purchase order does that item find itself? And then, when goods are manufactured by an overseas vendor, how are all of those POs accounted for on a container-specific basis? We said this a few slides back. Granularity, container, purchase order, item. Make sure, as an importer, that you choose an Incoterms rule, a shipping term, that does the most benefit for you, that creates the most benefit for you. Maybe designating the freight forwarder at origin and control of inbound cargo flows. Once again, we're not here to tell importers how to run their business. But as a trick of the trade, as a rather beneficial policy, it's not a bad idea to pick an Incoterm like free carrier, FOB, that allows you to designate the freight forwarder and control the inbound flow of cargo. Third point, consider using affiliate companies for freight forwarding at origin and customs clearance at destination. Let's just say that in an international context, integrated logistics unequivocally started with the integration of freight forwarding with customs brokerage. That's just a historical fact. You may consider, as an importer, using the same forwarder as you do customs broker, sharing of information, pre-clearance capabilities, greater visibility, less people to deal with on individual import transactions. There's a bunch of benefits to using the same forwarder as a broker, but you don't need to do that. We're not here to tell you to do that. We're here to suggest that it's not a bad idea. Take advantage of pre-clearance through U.S. Customs and Border Protection. One would be surprised to learn that many importers, or the people that work at many importers, are unaware that pursuant to U.S. Customs and Border Protection regulations, ocean freight shipments can be cleared 5 days out of port, and an air freight shipment can be cleared once the goods are confirmed on board a vessel. You want to talk about ways to reduce cumulative lead time? What a great way to do that. 5 days out for ocean freight, confirmed on board for air freight, clear your goods before they get here. Use 3PLs to help manage origin functions with vendors, especially if you as the importer, you don't have an office in Hong Kong that can deal with vendors in South China, or you don't have an office in Saigon to deal with Vietnamese vendors. The 3PLs either have their own offices or affiliate agent offices in many of these places. Use them to create that visibility, to coordinate activities with vendors. As part and parcel of using 3PLs to help with origin functions, make sure you have standard operating procedures in place, detailed SOPs that define all responsibilities and key performance indicators across the import supply chain. Here we are again, the 4 objectives of managing inbound supply chains. We said we were going to repeat ourselves, and we were not joking. At least we can be brief on this slide. All import activities, supply chain related, logistics related, have to focus on the following: maximize your sales opportunities, control landed costs, reduce and stabilize cumulative lead time, and optimize your inventory investment. The guiding principles. We're not saying that these are the only objectives, but if an importer focuses on these 4, they're 75 to 80% there in terms of what they need to be doing. Let's visualize those objectives by talking about the financial side of supply chain and the execution side of supply chain. In the end, balancing sales with inventories. In our first little seesaw, and hopefully they will be that balanced out in the real world, the essence of supply chain, we've mentioned it a couple of times now, we need to balance our sales and our profits with how much money we have to invest in inventories. Whether it's raw materials or finished goods, we have to very closely watch, based on a forecast and actual customer demand, how much we invest in inventory so we don't get caught short and not have enough, or get caught at the end of a selling season with too much. The top half of this slide, in the most simplistic of terms, is what supply chain is all about. Moving more towards a financial understanding as it relates to financial reporting requirements, we want to create a balance. On the left-hand side, the income statement, that's where sales and profits are shown. How much did we sell? What did it cost us? And did we make a profit? Versus, on the right-hand side, the balance sheet. Because on the balance sheet, that is where the values of inventories appear. And in the middle, without getting too deep into accounting and finance, the most important report as it relates to supply chain tactical execution and financial outcomes, cash flow from operating activities. Why is that? Because cash flow from operating activities demonstrates quantitatively, financially, that actual outcome, that actual balance between sales and profits and investments and inventories. Simple looking slide, very, very powerful as it relates to understanding the financial ramifications of supply chain activities. Last slide in this section. Import supply chain objectives and financial outcomes. This looks a little bit like the 7P2T methodology slide that we looked at some time back. It looks like it because what's on the left was actually on the right in the 7P 2T slide. There's a reason for that. It's not a coincidence. Our 4 objectives on the left, we won't repeat them again, but how the results of those activities reflect themselves where? On the income statement, the balance sheet, and the cash flow statement. We'll talk more about supply chain finance way down the road in deeper modules, but for now, this is the link. This is also the end of this section, and we hope that you return quickly. When we come back, we'll talk about the details of the 4 objectives and some examples of how they work.